Today, folks, VDY till a motherfucking die. My favorite Canadian monthly paying dividend ETF is green on the year thanks to these recent Canadian dividend stock earnings that we need to talk about because we had three major earnings in Canada today, and that was Bell, we had Canadian Natural Resources, and Shopify. And to my surprise, Shopify was the underperformer. Bell jumped up 5%. Canadian Natural Resources jumped up. I mean, the telecom space here was in an absolute depression. What did Bell do? They cut their dividend, and yet the stock still went up. We'll talk about Canadian Natural Resources on the back of oil prices, natural gas prices coming down. This company's still crushed, which is all a surprise, I'm sure, to shareholders out there. Pleasant surprises. I focus less on the tech companies here in Canada and more on these Canadian dividend kings. And VDY does a great job at market cap weighting these. It is literally a market cap weighted ETF that really has kept in line, or for most part has actually outperformed the broader Canadian markets like the S&P TSX. And I love this system of market cap weightings. Yes, it's concentrated. No, I would make this like a large core holding of my portfolio, but it does pair nicely with my S&P ETF, some of my tech stocks, and it gives me those upper weightings and things like Royal Bank, TD, Enbridge that all make up like closer to 10%, or in Royal Bank's situation 13%. But if you scroll down, you will see Canadian Natural Resources at 5.5%. You will see TELUS and Bell in here making up over 3.5%. I mean, TELUS and Bell aren't materially impacting stocks in this portfolio, so even though they cut the dividend, it's not going to be like the hugest impact to the monthly dividend that we are receiving. But still, these stocks are positions that I am holding through this ETF, so we should talk about them, right? So let's start with Bell first and foremost. This is a stock analysts think could be trading up as high as $45 or as low as 28, which is pretty close to 28 now. And the average analyst is at around 34. Today, we are now at 31.44. And the dividend, yes, got cut. And this was a good thing in my opinion. A lot of investors were crying for it. And this is the first material cut we've pretty much ever seen in their history, with the exception of the pause during the '08 financial crisis. And this was not a small cut. Now, keep in mind their net earnings of $683 million was up 49.5%, with net earnings attributed to common shareholders of about $630 million, which is insane. They are adding some money to the bottom line, which is peculiar for companies that have been bleeding like crazy through layoffs, cutting so many parts of their businesses. This company's been issuing debt, dilution, you name it. In fact, their dividend program, the management thought they'd be brilliant. They're like, if we cut our dividend, shareholders are going to leave. So instead, what we should do is just offer them a dividend reinvestment plan where if they reinvest the dividend into our company, we'll issue them a new share at a discount. So we get that dividend is basically, our money back. We just get that money back. We give them a discount, but it's an issued share, so we can use that money to solve our problems. Yet investors were like, why are you doing this? This is dumb. Just cut the dividend, and they did. They cut it down to $1.75 from $3.99. So we were getting $1 annually, and now we're getting a dividend that's more comparable to where we were at in 2010. Now, you might hate that if you're an income-oriented producer, but I am still a total return investor for the most part, and they're claiming they're trying to optimize the balance sheet, accelerate deleveraging, hybrid debt issuance. We've talked about cash tender offers, non-core asset sales, dividend now at $1.75. Invest in growth seems a little redundant, because all they're going to say is put customers first, offer the best network and services. They just invested, I think, in a fiber optic company in the US, and they're all moving to fiber. The problem is the traditional lines were a little bit more costly, but they're not seeing a premium on sale to fiber. Actually, fiber selling at most cases for cheaper, sometimes in the old traditional, sales they were getting for new internet or whatever. But yeah, they're in a troubling place. Like, they've been in a depression, but it's not necessarily a bad thing because I've looked at them as recovery plays. You're going to keep paying your phone bill. You're going to keep paying your internet bill regardless. They're just not getting any revenue growth. So we've seen a flatlining into the downside in revenue. If you look at total operating revenues at $5.93 billion, this is actually the lowest revenue they've seen in basically the last 4 or 5 quarters, which is not great, but it's not that materially down. The problem is they've been spending so much and trying to get through higher interest rates, layoffs with severance packages, and all this stuff has been deteriorating their earnings that have bolstered the insanity out of their payout ratios that made people say, hey, you can't afford that dividend. And now I think finally they're waking up to the reality of what it might take to turn this company around. So revenue growth is garbage. Most of the the guidance is not great here, except for free cash flow. They're trying to bolster back to 11 to 19%. Obviously, a lower interest rate environment will definitely help do this, along with getting those severance packages out of the way, and a lower dividend will give them that extra hopeful cash flow to get them through some troubling times. But this could be the bottom. for this company. Again, if we zoom out on these charts, you look at the last 5 years, Shopify, definitely being a bit of an outlier here. In fact, actually, no, I think we're looking at the wrong chart. We're looking at Canadian Natural Resources has been the outlier. Shopify over the last 5 years. Has Shopify really been flat over the last 5 years? Wow. And Bell has just been an absolute shit show. I mean, for the most part, it's been just eating through all shareholder return. If we zoom out on Max, this isn't a good chart to zoom out on Max because the history doesn't line up incomparable. But nonetheless, we kind of get the point here. So that's kind of where Bell's at. And I want to talk about Shopify before we talk about Canadian Natural Resources, because Shopify shockingly tumbled on basically, weak volume growth from merchants, which is a bit of a shock, but not a surprise. I mean, with Amazon having to deal with China, with a lot of people concerned about the economic circumstance, and overall analysts still have a high of this at a 151. Right now we're trading at 92, and the average analyst is at 116. I don't like Shopify. I've never liked the Canadian tech sector because they tend to get wildly overvalued, which I was spouting in 2022 before it crashed by 80% and still hasn't fully recovered back to those points. I've never liked the tech sector in Canada, so I'd rather focus on companies like VDY rather than the broader Canadian indexes. But overall, I mean, their guidance is great. Their guidance outlook, their numbers were absolutely jaw-dropping. They're still continuing to crush. They're growing at double-digit paces. It is the next most important tech company, I think, to Amazon when we're talking about e-commerce. And yeah, I think over the holiday quarter, their subscription solutions and their merchant solutions did drop off quite a little bit, but that's because the Christmas quarter is so strong. But if you look back over any other time, I mean, they're still a great company. I don't think growth is like materially slowing down by any metric, but I don't know how you don't look at this and say this isn't a great company. It's just what value is it worth getting in at? And now that they've cut off all the bullshit, I mean, they were trying to get into the actual e-commerce, warehousing solutions like Amazon was, and they realized that was a bad idea. You see a lot of flip-flopping on some of these companies trying to just figure out what shareholders want, how to bolster the bottom line. And I don't know why they purely just don't focus on, some merchant solutions and subscriptions. I'm shocked that subscriptions is actually the smallest portion of their revenue. But I don't know. You guys like Shopify? Are you buying it here? I'd love to hear all about it as we take a look at Canadian Natural Resources. This stock, traded down 30%. I think it could be a potential buying opportunity, but it was trading down, I think, in line with what we've been seeing out of crude oil. Natural gas is now pulling back from the heating cycle of the winter, but man, oil prices have absolutely plummeted. And this being like one of the largest oil and nat gas producers in Canada, there was quite a bit of concern over the earnings, but they've done some stuff to bolster their bottom line quite substantially, enough so that the stock popped 5%, right? So again, analysts have this at about $63. We're trading at 42, so it could be cheap. If we look at the dividend growth rate, this is the largest and fastest growing Canadian dividend company out there. 5-year growth rate 23.2% with a payout ratio of 43% roughly. You will not find a Canadian company with this kind of growth rate at this level of a dividend. I mean, we're talking about a 5% yield. Whew, baby, it's astonishing. So if we look, basically, they've increased the number of wells, but they've been able to really dramatically increase production out of some of these wells. Like, I mean, even their nat gas went from 19 to 23 gross. I mean, their entire, company is somehow just pooping out oil like there's no tomorrow. And they bolstered their net earnings by $2.458 billion versus $987 million this time last year. Absolutely shocking, which you can see if you look at the natural gas and crude oil outputs. They have materially gone up. I think crude oil has gone up by more than 10%. Natural gas also up by, I think, over 10%. So, this company is continuing to prove that there's a lot of people out there, even on the back of the U.S. tariff drama, that want to buy this oil. And regardless of oil prices, they're proving they can still bolster their net income quite significantly. So I was shocked by these earnings, as I'm sure many people out there were. But it's nice to see that Canadian Natural Resources is passing it off to the shareholder, right? 5 years up 267%. This will be likely one of the most important Canadian companies in the future next to the banks. And like I said, I'm super glad that I get exposure to the upper weightings of all of these. And it'll be neat to see where our economy goes from here on the back of interest rate cuts, what it might mean for Manulife, the bank earnings coming up and so much more. But you'll have to subscribe to get those updates. But I'd love to know, again, what you think in that comment section below.